All right, go ahead and record this so that I can post it. Okay, folks, I'm going to go ahead and share my screen. I can see a couple people on video, so maybe can you just nod and just like make sure that you can hear me? Okay, I got a thumbs up there. Okay, good. So good to go. All right. I just want to make sure that the waiting room is turned off so people can just join. And I knew how to do that 2 minutes ago, and now I can't find the button. All right, I'm going to go ahead and jump in. I'm going to get this presentation going. What I've got today, folks, is just a short presentation. I just kind of thought it might be helpful to lay out 10 important trends that I think we should be watching over the next quarter that'll sort of lay out the direction of this market. We know that there's a lot changing. I'm going to provide some updates on what's happening on interest rates, and we'll get into all of that. But I do want to jump right into this here. So let me go ahead and share my screen. No, I want to share my screen. All right. Okay, folks. So once again, thank you everyone for tuning in and for your support in getting Edge Analytics off the ground and rolling. And we've got a lot to talk about. I appreciate your time, and so let's just jump right into it. I am like the least creative person when it comes to like catchy titles, and so I have titled this 10 important takeaways and things to watch this quarter. That's as creative as it gets, but we're going to jump right into it. I think it's going to be kind of helpful in terms of framing where I think we're going. So I want to start with this. I think, oh, sorry. What am I doing here? Let me go back. Okay, I want to start with just a quick overview of what's happening with the economy, because I think it's important to note that the economy is still extremely strong. And so when we look at the unemployment rate, we just set a record low. Okay, we've never seen unemployment this low. So this is astounding. We actually are sitting at just over 5% unemployment rates, never been this low. And not only is it this low, but consumer balance sheets still look really good. Okay, we've got a lot of assets still on household balance sheets. They continue to look good, and so there's a lot of assets backing the debt. We know there's a lot of debt. We're going to talk about that, but a lot of assets still backing that. And so I think it looks still quite solid from that perspective. Okay, now what's been interesting in the last couple of weeks is we've gotten some really neat data around this shortage of labor. So we just said that we've got the record low unemployment rate. Okay, so if you want a job, you can find one. Okay, but at the same time, the share of businesses that are reporting a shortage of skilled labor is as high as it's ever been. So you can't find workers right now, and I think that's a big problem. And it's a problem in the sense that I think what's going to happen here is wages are going to have to go up, or the economy has to cool a lot in order to kind of balance this. And so what we're starting to see is an early sign that wages are beginning to tick back up again. And so we got some data just this week looking at wages in Canada, and they came in at the highest on a year-over-year basis in about 15 years. And so that's very positive. You've got strong wage growth. Now, this also poses a bit of a conundrum for the Bank of Canada, because it does raise the risk that, see, what happens is you can get into what's called this wage price spiral, right? Where wages start to go up, People have more money to spend. There's more demand. It pushes prices up. And then because prices go up and because workers have a lot of bargaining power, they're like, hey, listen, my food bill went up 10%. I want a raise. And employers have to pay it because there's such a shortage of labor. And so it creates this sort of feedback mechanism that can actually feed back into inflation. And so it's a weird thing where this strong wage growth is both a good thing for consumers, but it also means that the Bank of Canada is recognizing that this economy is running very hot and is in need of being cooled. Okay, and so that gets into some of the projections around interest rates that we're going to talk about in a moment. But listen, consumers look good. And I would say that one of the other really important things that jumps out in the latest data is that there's still just no signs of stress in household finances. And there's a few ways that we can look at this. One of them is just by looking at consumer insolvencies, which are both bankruptcies and proposals. And I've showed this chart before, but basically it's really interesting that heading into the COVID crisis, we actually had a pretty significant run up in consumer insolvencies in Canada leading into COVID. Then you had the biggest macroeconomic shock of our lifetimes. And what happens? Everyone expected it to go up, myself included. It went the exact opposite. Of course, a big part of that was just that you had this enormous government response in supporting incomes. But the point is, we're 2 years after the onset of the pandemic, and we are still 40% below where we were for consumer insolvencies heading into the pandemic. And there's no signs that those are ticking up yet. So that's remarkable. The other one that I think is really important is that credit card delinquencies are still at record lows. And I think that's important for the folks on the call who perhaps are running pools of private credit, mortgage investment corporations, or private lending. You're obviously always concerned about, when does the cycle turn? What are the forward-looking indicators that might suggest that delinquencies are going to tick up in my portfolio? And with a lot of people will source or they'll reference mortgage arrears data, which you see kind of widely referenced in the media. That's from the Canadian Bankers Association. The problem with mortgage arrears data is that it lags really badly, right? So here we are, we're almost into June. We only have the latest data from February. And because of the reporting requirements, a lot of times mortgages aren't reported as being delinquent until people have missed payments for anywhere from 3 to 6 months. And so the mortgage arrears data that we get today reflects people that stopped making payments like last August, right? I mean, it lags so badly that it's useless. And so what I suggest people watch instead are credit card delinquencies. And there are great, very timely data around this. There are credit card trusts, which are just these pools of credit card receivables. They report monthly, so we already have data from April. And I'm just telling you that by and large, consumers in Canada will not miss a mortgage payment before they skip out on a couple of credit card bills. And so it's intuitive that you will see credit card delinquencies begin to tick up well before you see mortgage delinquencies tick up. And there is still no sign of that. Now that's going to start to change. And this is one of the reasons why I'm flagging this here. I think by the time that we all get back on a call again in 3 months, there will be some tangible signs that this is starting to tick back up. But if you took a snapshot of households right now in Canada, it looks very good. There's no sign of stress among households right now. And so, hey, listen, let's take the good news where we can get it, because there is some bad news coming. All right, population growth. It's still booming. I mean, it's remarkable, and it's leading to a very tight rental market. So this is very fresh data. We just got the Q1 data from IIRC, which is the government entity that tracks population numbers and immigration. So the chart on the left is permanent resident admissions. And so when you hear the word permanent resident, like just think about that as when we think about immigration, that's what we're thinking about. Okay, so when the government talks about a target of 430,000 new residents, this is what they're talking about, permanent residents. Okay, and look at the numbers for Q1. I mean, they just blew away every other year. So we are well on our way to meeting those population or those immigration targets. And it looks certainly like we're going to set fresh records this year. But the other thing that's very important, and I think this is still not fully appreciated as a source of rental demand, is that non-permanent residents continue to boom. Okay, and these are not captured in kind of the official, when you hear about the government talking about immigration targets, they're talking about permanent residents. They're not talking about, for example, international students. But international students are a massive source of rental demand. And so if we look at what happened in Q1, and again, this is data that just came out this week, international student admissions were the highest on record by a wide margin. I mean, double what it was just 5 years ago. I mean, it's remarkable. And so the population growth is still extremely strong in Canada. There's no reason to think that's going to change. And what that's leading to is a significant tightening in the rental market in big cities. And I think there's actually two things at play here. One is that we know that sales volumes are slowing. We're going to talk about that in a moment. And listen, people have to live somewhere. So you're either going to buy or you're going to rent. And if fewer people are buying, that means that you've got more people renting. And so if you've got more of the existing population that wants to rent, and you've got that strong population growth, especially from international students that tend to overwhelmingly be renters, then you end up with a tightening in the rental market. So what you're looking at on the left is the lease to list ratio for rentals in the condo market in Toronto. And so the lease to list ratio is just, it's kind of akin to the sales to new listings ratio. It's just a measure of supply and demand in the rental market. And all you need to know about this ratio is a higher lease to list ratio means that the rental market is tighter, okay? And so what did we see in Q1? We saw the tightest rental market in Toronto since at least 2015 when they started releasing the data. And I suspect it goes back much further than that. So the rental market is tightening. The folks on the call, I'm sure, can attest. We're now seeing, rampant bidding wars. You're even hearing stories of people holding off on offer nights on rentals, which is that's crazy. We never saw this before. And you're seeing it now in the increase in the rental prices. This is looking just at the condo rents in Toronto over various types, bachelor, 1 bedroom, 2 bedroom. Some of this is base effect, right? So we had a couple of years where those rental rates dropped. And so now we're kind of bouncing off those and the increase look exaggerated, but still you're talking like almost 20% year-over-year increase in rental rates in Toronto. Pretty wild. Now, I will say we're going to look in a moment at what's currently under construction across the country, and there's a lot of rentals being built. Not so much in Ontario, but I mean, when you get into Quebec, a ton, and in BC, quite a bit, even in Alberta. And so I think as those come online, it should ease some of the rental pressures. But look, we're just, this population growth is just so dramatic that I think this rental market's going to be reasonably tight for a while, at least in let's say, Toronto and Southern Ontario. So we got that going for us. Now, a couple interesting points on housing starts. They continue to sit near record highs. So we're building the most. And again, a housing start, for those who aren't familiar with the term, it's just literally shovel goes in the ground, you start construction, that's a housing start. And so if you just look at the headline number, it's running at about 260,000 on an annualized basis, which is a lot historically. But if you then parse that out into 3 buckets, and if we call them single family, condos, and rentals, this is what it looks like. And what's interesting is the blue line is your single family, and it's generally been on a downward trajectory since the early 2000s. It's not really changing except in just the last couple months, which I'll show you in a moment here. But a downward trajectory in single family. Condos, we know, has generally been trending up. But look at the rentals. I mean, this chart still continues to really astound me. It's just a remarkable increase in rental construction activity across the country. And so we are seeing a bit of a rental renaissance happening in Canada. I do want to zone in for a moment on single family housing starts because I've made the argument for a while that I think we've been chronically underbuilding single family. It's not going to change in 1 or 2 months, but it is interesting to me that just in the last couple months, we've seen a pretty sharp uptick in single family housing construction. And I think, again, just based on the trends in the resale market, there's a relatively short construction timeline on single family, so there's a good chance these are going to be completing later this year, and they may be completing into a relatively weak market. So we may get into a situation where you've got a bit of an overbuild in the single family space later this year. But it's really very cyclical, not a secular kind of massive overbuild, because we just have underbuilt for so long. The interesting thing, I didn't include it in this slideshow, but there's actually an interesting data set that looks at completed and unsold developer inventory. So this is like a developer builds 50 single family homes in a certain subdivision, and 48 of them sell, and they're left he or she's left standing with 2 unsold units. And so CMHC actually tracks unsold developer inventory across the country. It's as low as it's ever been, right? So there's no sign that we have any sort of overbuilding yet among developers. Okay, and so we may, I think that'll start to tick up as we move through the year, but again, look, the supply demand numbers from a 10,000 foot level still look really good. Okay. If we instead look at what's currently under construction, so you've got housing starts, but then there's also the inventory of homes that are being built in total. And so, no surprise here, if we pull it into its constituent parts, you've got condos, a ton of condos being built. That's not a surprise if you're in a big city, lots of condos going up. Look at the blue line. This is a single family. It's like flat as a pancake over the last 20 years. We're not building any more single family homes than we were 15 years ago across the country. And so again, that kind of gets back to my more fundamental view that we're just not building enough single family. That's not to say we can't have little cyclical downturns in the single family segment, which I think we're in the middle of right now. But it's just not like a structural massive overbuild. But look at the rentals. I mean, this is remarkable. So for most of the last 20 years, we kind of have, at any point in time, there's anywhere from kind of 5 to 20,000 rental, like purpose-built rental units being built across the country. And then now it's spiked up, we're at about 110,000. So there's a lot. And again, that's really concentrated in like the Quebecs, BC, Alberta, to a lesser extent, and not as much in Ontario yet. And so we've got some catching up to do there. I did include this chart. I didn't think I had, but there it is. This is completed and unsold developer inventory. Look at the trend, right? So this is again, the number of completed units that have not yet been sold by developers. And it's just like, I mean, it's as low as it's ever been. It's remarkable. And so I think until this starts to tick back up, it doesn't look to me like there's any real signs of overbuilding on a long-term secular basis, right? It's enough that's really going to cause like a catastrophic downturn, okay? Notwithstanding that we're going to see a bit of price volatility over the next few months, which we're going to talk about. So let's leave that there. And I want to talk about interest rates and where I think they're going to go. I know that's top of mind for a lot of people. And I would say that there's sort of good and bad news here, depending on how you want to frame it. Let's start with the bad news. Variable rates are going to keep moving up. We've got a Bank of Canada meeting tomorrow. If they don't raise interest rates by 50 basis points, which is 0.5%, I will eat my left foot. It's just, I mean, it's baked into the cake. And if they don't do it at this point, then they lose a ton of credibility. And the reason for that is that inflation continues to run pretty rampant. We're almost up to 7% inflation nationally. It continues to tick up. And the bad news within the inflation numbers is that there's signs that it's still accelerating. So we can look at, this is looking at the year over year number, but we can also look at month over month numbers, seasonally adjusted. And those month over month numbers continue to accelerate. And so, look, there's a sign that this is probably going to get worse before it gets better. It's going to get a little higher. And that's a concern for the Bank of Canada. But the other thing that I think is a bigger concern, I've written about this before, but I really want to make sure folks understand it, is that consumer expectations are starting to become a little bit unanchored. Okay, and so there's a reason why this is really important. I just want to take a minute to unpack this. And for those of you who are on the call who were at the Mortgage Professionals Canada conferences in Vancouver or Toronto, you know that I presented. I spent a lot of time talking about this. So I'm sorry if I've covered this already, but I think it's worth unpacking a little more here. Inflation has a behavioral component to it. Okay, and so what I mean by that is if people's expectations are that inflation is going to be very high in the future, they tend to spend more today. And so, I mean, put yourself in the shoes of a business owner. Let's say you own some sort of a factory that makes widgets, and you have to, there's certain key inputs that you need, some raw materials that go into the making of that widget. Now, if you think that the cost of those raw materials is going to go up, 1 or 2 or 3% in the next year, you probably don't really care. You're just happy to kind of run at normal levels of inventory and kind of use up what you've got. But if all of a sudden you think maybe the price of the raw material is going to go up 10 or 20%, well, you're more likely to run out today and stock up your shelves before the prices go up. And it's the same thing with consumers. If you think it's, the price of building materials to build a new deck is going to go up 20 or 30% next year, you're probably going to rush out today and you're going to spend money today to get that built before the price goes up. And when you multiply that across an economy, what it means is that as expectations for future inflation go up, spending goes up today. And that can create this like vicious self-feeding cycle where as people think inflation is going to go up, they spend more, which pushes inflation up, which means people think it's going to go up, so they spend more, and it just feeds on itself. Okay. And so this is why the Bank of Canada is tremendously interested in inflation expectations for consumers. And so look at this chart. This is showing you where consumers have expected inflation to be 2 years in the future. All right. And the Bank of Canada has a target of 1 to 3% inflation. And so when you see consumers thinking, okay, inflation in 2 years is probably going to average about 3%, then for the Bank of Canada, they're like, look, mission accomplished. People think inflation is going to average close to 3%. That's our target. So they believe, in other words, people believe that we have the ability to control inflation. Okay. Now look at what's happened just in the last couple of quarters. Inflation expectations have surged. They're now closing in on 5%. And what that's telling you is that people are starting to doubt that the Bank of Canada has the tools available to cool inflation. In other words, the Bank of Canada has a credibility problem. And so it's really interesting. If you go back just 2 weeks ago, we had the deputy governor of the Bank of Canada give a speech where she was talking about the need to restore credibility. What is she saying? She's saying we are going to have to hike rates until we break this inflation expectations. Okay, and so the words that kind of the saying I've been telling my subscribers for a while now, and that when I've been giving these presentations, what I've been saying is the Bank of Canada is going to hike interest rates until consumers start to fear a recession more than they fear inflation. Okay, they're like on autopilot until that happens. Until inflation starts to come down and inflation expectations start to break, they're going to keep hiking. Okay, so we're going to get 50 basis points tomorrow. We're probably going to get another 50 basis points in mid-July. After that, it's much more up in the air. By that time, I think there's going to be some signs that the economy is maybe starting to slow at the margins, and the Bank of Canada will have a little more cover to kind of like pull back and wait. And so that's bad news for variable rate mortgages. But I actually don't think that it's going to move fixed rates that much. Okay, and so you can see what's happening on the interest rate side. This is data courtesy of Rob McClister. And what you're seeing is fixed mortgage rates continue to move up. They're kind of in that, on a fully discounted basis, they're kind of 4.1% on average. Variable has some catch up to do, and it's going to continue to catch up as the Bank of Canada moves. All right. Interestingly, we've seen consumers push aggressively into variable rate products. This is the origination share by different mortgage types. So the blue line is variable. Back in 2019, variable was only about 5% of new originations. Today, it's almost 60%. So consumers have pushed into variable, and it makes sense why they would. I mean, look at this gap between fixed and variable. Okay, but here's an important point. So variable is going to continue to trend up because variable follows the Bank of Canada. But fixed mortgage rates reflect the bond market, and in particular, 5-year bond yields. And what's really important to remember is 5-year bond yields predict where the Bank of Canada is going to be. Okay, so in other words, they've already priced in that they expect that within a year and a half, the Bank of Canada is going to have its overnight rate up to about 2.75%. Right now, it's 1%. Okay, and so this is really important because what this tells us is that the Bank of Canada can hike interest rates 50 basis points tomorrow. Fixed rate mortgages are probably not going to move. The only reason that they would move is if the Bank of Canada hikes 50 basis points, and then in the language of their press release, if they say something along the lines of, we now think that we have to hike, the neutral rate has moved up, right? So in other words, if they say, we previously thought we'd have to hike to kind of 2.5 or 3% to cool inflation. Now we think it's 3.5%. Well, that would move the bond market, and that would move fixed rates. But if they just raise 50 basis points and they kind of reiterate their former view, fixed rates aren't going to move. And so I actually think we're in a situation where, unless something dramatic changes, fixed rates are probably as high as they're going to be for a while. Variable rates are going to close the gap and catch up. Okay. And by the way, I actually think we may be looking at a bit of a peak in fixed rates for a while. It's hard to imagine they're going to get much, much higher unless inflation starts to really accelerate to the upside here. And I don't know that that's likely at this point. Okay, so just to throw it on here to kind of reiterate the thinking, fixed rates are forward-looking. They reflect where the bond market thinks the Bank of Canada is going to be, okay? So fixed rates are already pricing in the Bank of Canada overnight rate in around that kind of 2.5 to 2.75% range. And so even if the Bank of Canada hikes 50 basis points tomorrow, which they will, probably won't affect fixed rates unless they signal that they're going to be going above that, okay? I do think that the Bank of Canada is going to continue to hike inflation, or to hike rates until people start to fear a recession more than they fear inflation. They're kind of on autopilot on that, right? So that means we're going to see Bank of Canada hike 50 bips in June, so that's 0.5%, likely another 25 to 50 bips in mid-July, and then we're going to maybe be in a wait-and-see mode and see what happens beyond that, okay? It's important to remember that interest rates hit with a lag. Okay, so when the Bank of Canada raises the overnight rate, it can take up to a year for that to filter through to the economy. And they know that. They reiterate that point over and over again. And so the Bank of Canada is always leery about hiking too quickly. And then it hits with a lag and it crushes the economy. They're like, oh crap, well, maybe we should have gone that high. And so they're probably going to hike, and then they're going to want to wait and see how that affects the market, filters through, and then sort of revisit. So I think by kind of, by the July meeting, we should be in kind of a wait and see mode where the Bank of Canada might just take a bit of a break, which is good news. Good news. Now, what does that mean for consumers in Canada? Well, the bad news is the damage has kind of already been done. All right, interest rates are starting to really hurt. It's going to hurt for a while. And so what you're looking at on the left, this is a measure that's called the household effective interest rate. It's calculated by the Bank of Canada on a weekly basis. And what it's meant to represent is the average weighted interest rate that consumers are paying across all credit products. So credit cards, auto loans, mortgages, obviously weighted based on the outstanding balance. And so if you look a year ago, we were sitting at about 2.5% interest rates. That's across all credit products. So that's including credit card debt, including autos. The average interest rates that households were paying was 2.5%. I mean, that's absurdly low. But look at what's happened just in the last few months. This number is spiking. It's now to the highest it's been since 2009. It's over 4%. And so to go from 2.5% to 4% in 1 year means that the effective interest rate has moved by about 150 basis points. That is the largest annual increase in at least 20 years. And so this increase in interest rates is flowing through to consumers very quickly. Okay, it's one of the reasons why I think the economy towards the back half of the year, we're going to start to see some signs that it's wobbling a little, and it's probably going to force the Bank of Canada to rethink some of its tightening bias. Okay, it's maybe going to put the brakes on a little. All right, so that's just a quick run through of what's happening on interest rates. Again, 50 basis points in June is baked into the cake, probably 50 basis points in July, and then at that point we wait and see. But again, fixed rates are probably as high as they're going to go, unless we get something really dramatic happen. Variable is going to continue to move. Now let's talk about what's happening in the affordability front, because I continue to think that this chart that you're looking at on the left is the most important chart in Canada right now in terms of understanding what's happening. So I want to unpack it a little bit. So every month, the Canadian Real Estate Association calculates the price of the typical home that's sold. It's not the average, okay? Because the average gets skewed if you get a bunch of high-end homes sell. Somebody buys a $30 million property, the average for all of Canada jumps up. It's like it's pretty volatile. And so what it's meant to do is kind of adjust for those changes in composition, and they report it in what's called the benchmark price. And so if you took that benchmark price every month, which kind of reflects the typical home being sold, and then you figured out, okay, how much would my mortgage payment be if I finance this at 80% loan to value, 30-year amortization with the typical 5-year mortgage rate? By typical, I mean kind of the average between the discounted 5-year and discounted variable rate, average that out, and what would those mortgage payments look like? And so you can see what it looks like. It was kind of bumping along. It was relatively flat from 2017 all the way through 2021. And in the last 6 months, we've seen the mortgage payment to buy the typical home jump by almost $800. Now, I want to be really clear here. This is not suggesting that mortgage payments for people who already own their home have jumped by $800. What this means is that if you were a prospective first-time buyer looking to buy into the market, the affordability has just deteriorated dramatically. And so we can talk about supply-demand balance all that we want. We can talk about a tight labor market all that we want, but I just don't think we're going to offset an $800 a month increase in monthly mortgage payments without something breaking. And either it's going to be interest rates have to come back down or prices have to come back down. And for right now, it sounds like the Bank of Canada is pretty steadfast. And so I think, unfortunately, it's going to get vented a bit through prices for a while until things stabilize. And so when we then think about, okay, well, what are the parts of the country that have seen the steepest deterioration? It's not uniform at all, right? I think everyone sort of understands that BC has been unaffordable for years, and there's some reasons for that. But what has me a little more concerned is the extent to which Ontario has seen affordability deteriorate. So what you're looking at in this chart is kind of an estimate of mortgage payments as a share of pre-tax household income. Again, if you're buying kind of the typical home. All right, and so in Ontario, that number has spiked. In Quebec, it's even jumped up. Alberta, I'm not really that concerned about. It's housing, even with the backup in interest rate, housing in Alberta is more affordable today on a carrying cost basis than it was 20 years ago. There's really nowhere else in the country that's true. So I'm quite concerned about what this means for Ontario. I'm much less concerned about what this means for Alberta. So do with that as you see fit. But I do think, look, these are real affordability constraints, and they're going to get vented through a weak resale market in Alberta and parts of BC. And it's going to mean a lot less for Alberta in the interim. And so what does that mean in practical terms? It means that sales are starting to fall. They're still relatively high historically. If you look at the chart on the left, this is home sales in Canada on a seasonally adjusted basis. We're still above where we were in 2016 and 2017, which were relatively frothy periods, right? These were the periods of time where you had, like, the regulators brought in B20 to cool the market, and there were foreign buyer taxes in BC and Ontario. And we're still above those levels in terms of home sales, which probably tells us that sales are going to fall further before they stabilize. But what's interesting is what you're looking at, this drop that you're seeing. Last month, we saw the biggest monthly decline in home sales on a month-over-month basis that we've seen since B20 was introduced in 2018. I sort of set aside, that's notwithstanding kind of April 2020 when everything got locked down, because that's kind of an artificial comparison. So I kind of throw that one out. But this is look, we're seeing a real steep decline in sales transactions. It's most pronounced in Ontario, where you would expect because of the affordability constraints. We've seen a 30% decline in sales over just the last 2 months. The last time that happened, again, outside of April 2020, was during the financial crisis in 2008. So we're seeing a very significant slowdown in demand across the country, but notably in Ontario. And Ontario is kind of driving the bus on a lot of the national trends right now. I'm going to highlight a couple of the other provinces. This is BC. Again, we're still relatively strong levels historically, but off the peak and probably more downside to come. I think nationally by the end of the year, we're probably still going to be down 20 or 25% sales volumes from current levels before it stabilizes. And Alberta is much as you'd expect, given that the affordability constraints are not nearly as severe. We've seen a little bit of a pullback in the last couple of months, but I mean, otherwise record home sales levels. And I do think for a number of reasons, Alberta is going to continue to generally outperform the rest of the country for a few reasons that we can talk about. Now, I just want to highlight this. This is kind of an interesting sort of separate data point, but I find it fascinating that consumers in Canada still by and large are not like super worried about housing. I think most people aren't super aware of what's going on in the resale market. I actually had a conversation with a family friend, and he is like, they're considering upgrading their home and taking on a considerably larger mortgage. And he's like, yeah, right now we've got a fixed rate mortgage. It's like 1.8%. And so, that renews in a couple of years. So, I mean, I feel like we could afford, a mortgage that's 4 times what he currently has. And I was like, dude, do you know what's going on with mortgage rates right now? Like, you're going to be renewing at closer to 4%. And he was blown away. He's like, whoa, hold on. Then he starts running the numbers. He's like, whoa, that's a huge hit, right? And I think for the average Canadian, they don't really understand right now what's going on with rates, right? Unless you're out there actively trying to buy a home, you don't really know what's going on with interest rates. And so why I think this chart is so important, this is a real estate outlook index, and it's calculated by Bloomberg and Nanos. And basically what they ask Canadians is like, do you think house prices are going to be up, down, or sideways in the next year? And so what you're looking at is the share of Canadians that think that real estate is going to keep going up. And what's fascinating to me is that you still have a higher share of Canadians that are optimistic on real estate than what we had in 2017 when the market was ripping in Toronto. So even though we've pulled back a little bit off of kind of the crazy levels from earlier this year, this sentiment level is still very high. I just don't think the average Canadian understands what's happening with rates yet. They will, but we're just not there yet. And so that tells me that probably, again, sales are going to come down a little more because the sentiment hasn't fully shaken out and people don't really know that financing is quite tight. The rates have gone up a fair bit. Now, inventory is starting to trend up, but it's still absurdly low. And that's even with very low level of new listings. So this is quite an interesting chart. New listings in Canada, in spite of the fact that rates have gone up and prices are starting to cool, we have not seen a big jump in new listings at all. And I think this is going to be a big tell. If we start to see this line really jump, that could signal that we've got some bigger problems to worry about. But right now, there's no sign that people are like just, listing like crazy to just fire sale their investment properties or whatever. That's not happening. New listings are completely stable. But active listings are starting to go up. And the reason for that is just simply that if you have a steady flow of new listings, but sales fall, that means it takes longer to sell things and kind of inventory accumulates a little. But I just have to highlight how low this level is still. So we're still only on a seasonally adjusted basis. We're still only about 110,000 homes for sale across the entire country. In 2015, that was 250,000. So we are still less than half of sort of normal levels when it comes to inventory. But this little blip right here represents the biggest 4-month increase in active listings in 12 years. So inventory is building. Okay, it's starting to tick up. This market is beginning to move back towards a more normal market. And once again, I don't mean to keep picking on Ontario, but Ontario is where this is happening the most. We're seeing active listings start to tick up again from a very low level, right? We're still less than half of normal levels. But in the last 4 months, since the market bottomed, the number of active listings has risen by the most in over 20 years. Okay, higher. We've now seen inventory build faster than we did in 2017 over the last 4 months. Again, on a seasonally adjusted basis. So, something to watch. If this keeps going through the summer, then we may be looking at a bit more of a pronounced downturn. Active listings in BC, again, starting to tick up. Alberta, still not really. We're still kind of sitting near 12-year lows for active listings. It'll probably continue to tick up, but probably not as significantly as what we're seeing in Ontario. And so this brings us to prices. And I say prices are falling sort of, like they're not, it's kind of a fake move that we're seeing in prices. So because there's some chaotic selling in Ontario right now, because what's happened in Ontario is prices were rising so quickly for so long, people had to, in order to win a bidding war, you had to like pay 10 or 15% above any other comparable sale to win it, which means that like, how do you get that appraised, right? How does an appraisal say, yes, we think this is worth 15% more than anything that's ever sold in the area? And the answer is what people were doing is they were pushing back the appraisal to as close to the closing date as possible and hope that the comparables would catch up. And that works as long as prices keep going up. But if prices flatline, as we've seen now, or even decline, well, now all of a sudden you've got appraisal issues. And that's what we're beginning to see. In fact, I saw Ron Butler posted that they're finding that the appraisal failure rate is up to 50% in their products. So they're having half of their home sales the appraisals are failing on. And so that creates distressed selling. People have to close on a purchase that they've contracted to close on. They have to sell their existing home and they have to sell it. And they're selling it into a weak market. So you're getting this disproportionate decline in sales. And so what I would highlight is if we look on the left, this is months of inventory across the country. So months of inventory is just like a crude measure of supply and demand. Okay, if there's 100 homes for sale, 20 of them sold in the most recent month, you'd say there's 5 months of inventory. And 5 is kind of like your long-term average, 5 to 6. We're still just barely over 2. This is still a remarkably tight market. And where we can see that is in this chart here. And I was pointing this out to clients for a while, where you had, okay, what you're looking at here is months of inventory along the bottom and the monthly change in the house price index along the vertical axis. And the key point is prices have never before declined with less than 5 months of inventory on the market, except for last month, where you had a big decline in prices with only 2.2 months of inventory. That's never happened before. And so what it tells us is that there's like distressed selling that's not indicative of the overall market balance. Prices should not be falling, right? And so what's going on? Let's just jump ahead. Oh, by the way, this is what we're looking at nationally. Here's your benchmark house price. You can see that little tick right there at the top. That was April. And you can see April, biggest monthly decline since April 2020. It shouldn't be happening because inventory levels are still quite tight. Why is it happening? It's because of Toronto. I hate to put the blame on Toronto. It's Southern Ontario generally because we're seeing the same thing happen. But because of this distressed selling dynamic, you're seeing this bit of an exaggerated price move. So if we look at the seasonally adjusted change in prices in Toronto, it was the largest since 2017. It was actually the second steepest monthly decline in over 20 years in Toronto last month. And I'll tell you, that's not reflective of how tight that market is still. It's still a tight market. So what that tells me is, we've got a couple more months where this distressed selling has to kind of work its way through the system. And we're not really going to know what this market looks like fundamentally until probably July or August. And then what I think is going to be really important to watch is what's happening to the inventory levels. Because normally in any prior cycle, if you use 2017 as an example, sales fall, prices start to wilt a little, people get caught offside, they distress sell. But if you don't have to sell, then people look at it and go, well, I'm not selling into this market. This market's way too weak. And they pull their house off the market and they wait for things to stabilize. And that's kind of been the pattern. And so there's a chance that that might happen again, where come the summer, all the inventory disappears, the market stabilizes. But there's a chance that that's not going to be how this plays out, because interest rates do change things. And there may be some people who are might be a longer tail of somewhat distressed selling because interest rates are going up and people are having some affordability issues. I don't know. The jury is out. We'll get a better sense of what's going on midsummer. But this is the thing we need to be watching, is what's happening to inventory come July and August. That's going to be the big tell. And especially in Southern Ontario, where I think prices have run kind of the most. All right, I'm going to leave you with just a few kind of random tidbits, interesting things to be watching, and then I'll take a few questions, and there's a few questions that came in ahead of time. And so there's no particular order here. There's just kind of interesting things that came up in the last few weeks that I thought were worth highlighting. This is a big one, potentially. Wall Street Journal broke this exclusive that they had gotten this internal Chinese Communist Party manifesto or directive where the CCP is insisting that party elites start to sell their overseas assets. Okay, and the reason why they're doing this is because if you understand what happened with Russia, as soon as Russia invaded Ukraine, all of a sudden there were sanctions put on all these Russian oligarchs, like overnight. Just boom, we're going to take your house in London. If you had overseas, even some of the central bank assets. So, foreign bonds that were held overseas, they just basically stole them. Like Western governments just flat out stole that from Russia. No, no court, nothing, just boom, that's ours. And so China, of course, has had this longstanding issue with Taiwan, and there's a lot of concerns that China might try to invade and take over Taiwan. And so you can see that the wheels are turning within the Chinese Communist Party elites, where they're saying, look, if we do that, we don't want all of our senior people to have all their assets stolen. So let's insist they start divesting of those now. So look, I don't know if this is going to be a big deal, but I know what I'm going to be watching. And what I'm going to be watching is new listings and sales trends in Vancouver West and West Vancouver in the detached segment, because this has tended to be a landing pad for Chinese capital. Okay. And so if we start to see that new listings accelerate or sales really plunge, that's maybe a sign that this is a big deal. And again, I don't think it's a big deal nationally, but in terms of like high-end home sales in certain enclaves, this is potentially a very big deal if China really does clamp down. So something to watch. I'll be watching that in the next over the next few months. Next is, I think, what's going on with the condo market and the cash flow for investors is a big deal. So this is just a simple cash flow index. I just take condo prices in Toronto, average rents, discounted mortgage rates, and you can sort of back into like what the headline cash flow would look like if you bought a condo that month at 80% loan to value at prevailing rates. And you can see that the headline cash flow is kind of, it turned negative. We know that if you finance a condo at 80% loan to value, you're probably out a bit of money every month. But what's interesting is the orange line. If you then add back the principal repayment out of the mortgage every month, then you actually had a fairly consistent economic return over the last 7 or 8 years. Well, now, just in the last few months, because rising rates have caused the headline cash flow to deteriorate so much that there's now no economic return, even when you include principal repayment. And so the only way that people are going to make money on these condos if they bought today is if you get future rent increases, which is likely, or future price appreciation. But that's a very different value proposition than it was even 6 months ago. And so there's a lot more risk to that investment today. So what should we be watching here? I think the sales trends, and by the way, condos still look pretty good. I think they're holding up better than a lot of other segments. But I would notice that if we look at the active listings for condos in Toronto, and when I say Toronto, I mean the GTA, the normal seasonal build, if you look at the increase kind of over the 3 months from February to April, it generally, we've seen condo listings increase kind of 600 to maybe 1,000 or 1,200. And this year, we've seen a disproportionately large build in condo listings in Toronto. And so again, I don't know what that means from a longer term perspective, but it's something that I think is worth watching, because I could see a scenario where, frankly, investors just start to shun condos because of this exact reason. The headline negative cash flow just gets too steep. And so that's something to watch. I am a little concerned about that. The other one that I am concerned about and that I think is worth discussing is this whole work from home versus this insane run-up we've seen in cottage country, specifically in Ontario, but I know they're seeing this in parts of BC as well. But I'll highlight a few Ontario metros here. These are areas of the province that skew heavily towards recreational properties. And you can see, I mean, these price charts are all just insane. Now, there's a case to be made that maybe work from home is permanent, and it's caused a sort of secular shift, and that's going to keep these prices more elevated than they have been in the past. And I'm sympathetic to that view. I don't know. But what I would say is that any other tightening cycle that we've seen in Canada, anytime that the Bank of Canada starts to raise interest rates, and when incomes get pinched, the first thing that people stop buying are those big ticket discretionary purchases like cottages. If you are running low on cash, you still need a place to live, but you maybe don't need your cottage. And so what we tend to see is these areas are hyper cyclical. They boom more than the general market. And when the general market turns down, they typically turn down harder than the general market. And that's been the cycle in the past. I don't know if it's going to be the case, but I would just say that if we retraced half of the post-COVID boom, okay, so if you gave back half of the gains we've seen since COVID hit, these areas would still have appreciated 50% in 2 years, but they'd be down 25 to 30% off peak levels. And so that's something to think about. There's a lot of room to give back prices in these areas. And maybe the last thing that I want to comment on is just Alberta can continue to buck the national trend. Oh, I already showed you guys this chart on affordability. Alberta looks very good. I think there's a lot of reasons to be optimistic on Alberta, and I've taken a lot of pushback on that, even though I've been saying this for a year and a half. I think Alberta is going to outperform the rest of the country over the next couple of years. And there's a few reasons for that we can get into regarding just cheap startup costs. I think extreme affordability in the resale market, strong population growth. We're starting to see flows back into Alberta out of the provinces. But the other thing that I find fascinating is this, which is just that the construction industry is not yet responding to very strong sales. I think everybody in Alberta is doubting this current boom. They're kind of like waiting for the next shoe to drop. And so you've seen, like, the blue line is home sales in Calgary, and the orange line is the number of homeowner units under construction. So in other words, I backed out rentals, and this is just condos plus single family. And so you can see normally in every other cycle, home sales boom, and then 6 months later, a year later, you get a big boom in construction, right? And then the bust, and then construction falls. And it's been like that through every cycle, except for this one, where you've got, demand is off the charts. Developers are not yet responding. And I don't have a great reason for why that is, but what I would say is it's probably going to prolong this cycle, right? You're not really going to see a major issue in Calgary home sales or just the broader market until you get a lot of new construction, right? That starts to overwhelm demand again. And we're just not there yet. So I think that looks good. We get into Atlantic Canada. I know there's not a ton of people on from Atlantic Canada, but similar trends there, we'll say. Okay, and so I'm going to leave it there, and I do have a couple pre-canned questions. So what I'm going to do is I'm going to stop sharing this screen, and I do see there's a few questions in here in the comments. So I'll get to those, and then maybe if people just want to kind of raise their hand or whatever, and I'll call on them here and unmute them. But where are my pre-canned questions? Okay, I got a couple pre-canned questions that people wrote in about. What's going on here? Okay, the first one is, I get that inflation is high and expectations going forward are right there with it, but with a healthy proportion of this inflation falling into food and fuel, are higher interest rates and servicing costs not just pouring salt on the wound for Canadian consumers? Feels like the Bank of Canada is using a sledgehammer to try to solve a problem that requires a screwdriver. So all that said, my question is, if the Bank of Canada is doing its best to allay inflation concerns and re-anchor expectations while being fully prepared to thrust us into recession. So in other words, this person's asking, look, can the Bank of Canada control the inflation that we're seeing? And are they willing to risk plunging us into a recession to do it? And the short answer is, well, there isn't a short answer, but as short as I can make it is that if we look at core inflation, so the Bank of Canada actually tracks measures of inflation that strip out food and fuel. And it's actually the measure of inflation that they weigh much more significantly than headline inflation. And core inflation is spiking right now. So even once you strip out food and fuel, inflation is rising and it's like accelerating. They're absolutely committed to curbing this, and they definitely will risk us going into a recession to get us there. It's much easier to re-stimulate an economy than it is to pull back consumers' expectations of inflation once they start to run away on you. Okay, and that's really important to remember. The government can always stimulate. It's really hard to pull back consumers' expectations if they think inflation is going to run rampant. Okay, so yes, they're going to keep hiking, is the short answer. Second question, is there anything interesting happening with MICs, mortgage investment corporations, assuming they're facing higher funding costs, et cetera, et cetera? Look, I'll say that the folks that I'm speaking to in the mortgage investment space, there's not really anything interesting happening in the sense of delinquencies within their portfolio, mortgage arrears. It's still not happening, and you wouldn't expect it to based on what we're seeing in credit card trends. So it's a little too early to see that. But what I would say is I was speaking to a gentleman who works in the commercial real estate space, and they're definitely starting to see, I mean, I'll read to you exactly what he said. He said, I've got some major quote unquote bear porn lately in my line of work. He says bids for commercial properties have thinned out significantly and receiverships are becoming more and more frequent. And he says, weirdly, the most common occurrence is stacked townhouse sites. So I do think that on the construction side, one of the things that we've seen is this massive escalation in costs are causing people to, like developers to realize they've overextended, they can't complete, the pro formas are offside. And that's going to create some problems, I think, going forward in that particular segment. But in terms of like your bread and butter first mortgage on residential, there's nothing that I'm seeing there yet. I think it's a little too early for that. But if anyone on the call has anything to add to that, please, by all means, I'll call on you here in a moment. And then the third one, is sort of a pre-canned question that came in a little earlier, is this. I'm wondering if you have any early data on how trends might differ among different housing types and different price points. Okay, so what we're seeing, and I can speak to Toronto and Vancouver, because that's where kind of the price volatility is happening most significantly, and generally Southern Ontario, I guess. But what we're finding is the suburbs are getting hit a little harder. Okay, so the far-flung regions of the 905 are starting to see the price declines a little more significantly. And what's interesting, and what I didn't expect, because normally in most normal cycles, like in 2017, it starts at the ultra high end, and then it kind of works its way down, and then it works its way into the core. Okay, and that's generally been the pattern every cycle. And this one's a little different. We're actually seeing like semis and some of the entry-level stuff in the suburbs are getting hit hardest. And I think that's because that's the part where those first-time buyers just there was so much FOMO that people rushed into that space. So it's sort of two areas. The ultra high end is definitely weak. And then surprisingly, the entry level in the suburbs is a little weak too. What I'm seeing is that in the core, single family is still very strong. We're starting to see a little bit of softness in the condo space, but not, again, I wouldn't say it's dramatic yet. Again, keep an eye on the investor activity there, but that's kind of what we're seeing across trends right now. And again, I'm happy to take comment from anyone else on here. I see there's a couple questions here in the queue. Won't inflation continue to get worse if rental prices continue to rise, given it's the largest piece of CPI? It's actually accommodation in general, and rental prices, rented accommodations are one part of the overall accommodation bucket. Yeah, look, there's a good chance that inflation is going to get a little worse from here. I think it's probably not going to peak until this summer. So yes, inflation is probably going to get higher. Peggy Hill says, tomorrow when May inventory levels come, you'll find that we've doubled in the last month. Okay, so I mean, this is what I mean. We're definitely seeing, so we need to find a way to bring back first-time buyers that can't service the debt at these prices and these rates. Yeah, I agree with that. I think inventory level is going to continue to tick up. The saving grace for Canada is really that we're starting at such a low level of inventory, right? There's still a remarkably tight market. If we had been starting at 250,000 homes for sale across the country instead of 100,000, so if we'd been at normal levels of inventory, this would get ugly really quickly. But we're not. We're starting at such a tight market that we actually have room. You can double the inventory levels, and we're still only back to where we were like a year and a half ago, which was still a tight market. So I'm not trying to like say we're not going to have issues with inventory down the road, but this market still looks good. So yeah, that's not entirely surprising. And I don't know what to say about getting first-time buyers back, other than that I just think if the Bank of Canada doesn't move, then this has to get vented through prices. I just don't see any other way. Prices have to, unfortunately, come down a bit. Okay, regarding immigration, how many of these new permanent residents are already here in the country and simply being fast-tracked to PR status? Great question. The answer is a lot of them, but it doesn't matter. Okay, and it's a tricky thing to unpack, but normally what you have is there's a lot of people that come to Canada, a lot of people that leave Canada. And so on net, you end up with kind of the immigration numbers that are reported are the net number, people that come here minus people that leave here. And what we've seen in the last couple of years because of COVID and travel restrictions, that like hardly anyone was coming here, but no one was leaving either. And so all that we were doing is sort of fast tracking the people for permanent residents that were already here. But it's the same on a net basis. If all you're doing is turning people into permanent residents that are already here, and you're not getting the people that are leaving, then it ends up being the net effect at the end of the day. So I get where you're coming from on that one, Steve, but it actually doesn't matter from a population perspective. Population is going to keep growing, and that's just supportive of housing for a while. Longer term supportive of housing. Next few months, who the heck knows? Vince, what's the probability of a 70 bip hike tomorrow to try to gain back some credibility? It's possible. I'd be surprised. Now, if they hike 75 basis points, fixed rates will move, because that's a signal to the market that the Bank of Canada is going to be, they're showing that they're more serious than people thought. I don't think it's likely. I mean, percentage-wise, I think it's probably like 10% chance that it's 75 basis points, 80% chance that it's 50 bips, and maybe another 10% that it's 25 or zero. If they shock the market and didn't move, I mean, that'd be really shocking, but I just don't think that's that likely. One more here. Consumer credit is rising. How healthy are consumer balance sheets on a liquid basis? All right. That's a tricky one. Okay, so you're right. So net worth is surging in Canada, but a lot of that is a function of real estate. Okay, so you're right. It's sort of this weird dynamic where, yes, consumer balance sheets are strong, and yes, that should support housing. But the reason that the consumer balance sheets are strong is because of housing. I get that it's somewhat of a circular logic. Here's the only thing I would say is, if we look at, okay, let's use household savings as just an example. Okay, the savings rate, and we actually just got data on this morning. The savings rate in Canada in Q1 was 8%. So you go, well, what does that mean? That's the highest we've seen since the 90s. Okay, households are saving a lot still, and that's liquid savings. And so, look, there's a lot of reason to be skeptical about the Canadian consumer, but for the time being, they look good. They're going to run out of runway there, right? And if interest rates stay where they are by Q3, we're going to start seeing some pressure there. But for right now, things look pretty good. Let's see. Can housing starts be sustained given building inflation and the softening resale market? No. Housing starts have to come down. And what's interesting is, and this again kind of gets back to what we're saying, like I've made the point that I don't know how much higher the Bank of Canada can go because so much of the economy is levered to real estate. And so what do we mean by that? So the GDP numbers that came out this morning, 10% of GDP in Canada was residential investment. So residential investment is new construction and renovation and ownership transfer costs. So all the costs associated with buying and selling real estate. That was 10% of the economy. We've literally never seen it that high. And so can it be sustained? Like probably not. But if it's not sustained, that means the economy is going to be much weaker going forward than it has been. And so what does that mean for the Bank of Canada? Like I still think the Bank of Canada is a bit of they're backed into a corner. Like you got an inflation problem, but if they raise rates too much, you've got a real problem with the economy. And which one are they going to choose, right? And I don't think they've got much more that they can move before they're forced to blink. So look, I think we see, like I said, 50 bips in June, maybe 50 bips in July. and they're going to be forced to really stop and assess, because this economy is just so levered to real estate. They just can't keep tightening, is kind of my take on it. Okay. Tomorrow's rate increase is already reflected in fixed rates. I agree. Have we already priced in 50 bp increase in July, or should we expect to see fixed rates rise further? So fixed rates are assuming that the Bank of Canada overnight rate is going to get to 2.5% minimum. Right now it's 1%. So in other words, the Bank of Canada can raise their overnight rate another 1.5%, and that's just going to get it in line with where the 5-year fixed rates is expecting it to be. So the only way that we get fixed rates to move from here is if the Bank of Canada signals that they're going to move even more than that. So if they start to say, like, we think we have to raise to 4% to curb inflation, well, then you got a big move in fixed rates. But until they signal that, we've priced in the full move on fixed rates. Okay, as far as I'm concerned, until something really dramatic changes, as high as fixed rates are going to go, unless the bank really signals that they're going to be more aggressive. And I don't see it. Okay. All right, that's it for the questions that have come in written here. I don't totally know how to. I guess if people I don't know if you guys can like raise your hand if there's any questions. We might be able to see you on here if you do that. But I'll maybe just give it a. Oh, hold on. I think I saw. Sorry, guys. I'm fairly new to the whole Zoom thing still. I mean, a bit of a neophyte here, but I don't see anyone raising their hand. So, okay, why don't we leave it at that? If there's any questions that folks have, you can always email me. Happy to chat and try to answer questions. And we'll try to do this on a quarterly basis. If there's stuff that really gets crazy and exciting, I'll be sure to include it in the next note, and we can talk about it on the next call. But always happy to hear from folks. And again, thanks for your support in this new venture. And everybody have a great day.